Computing overhead variances. Mason Fender is a competitor of Matthews Fender from the previous exercise. Mason Fender also uses a standard cost system and provides the following information: static budget variable overhead, static budget fixed overhead, static budget direct labor hours, static budget number of units, standard direct labor hours, 0.025 per vendor. Mason Fenders allocates manufacturing overhead to production based on standard direct labor hours. Mason Fender reported the following actual results for 2018. Actual number of fenders produced 20,000, actual variable overhead 5,350, actual fixed overhead 26,000, actual direct labor hours 460. So we need to compute overhead variances for the year, variable overhead cost variance, variable overhead efficiency variance, fixed overhead cost variance, and fixed overhead volume variances, and explain why they are favorable or unfavorable. I'm going to scroll back up so we can see the information here. And then down in Excel, we can start filling in our information. And so we're going to start with the standard variable overhead allocation rate. And if you remember back, that was calculated as the budgeted variable overhead divided by the budgeted allocation base. And in this case, our budgeted variable overhead was 2,300. And the allocation base, they told us, was standard direct labor hours. And so our static budget direct labor hours was 575. And so we get $4 per direct labor hour. And so for our standard fixed overhead allocation rate, it's going to look just like above, except we're going to say budgeted fixed overhead instead of variable, divided by our budgeted allocation base. And so when we look at the material, or at the data up here, we have 23,000 for our fixed overhead and an allocation base of 575 because it's still the direct labor hours. So we have 40 per direct labor hour. Okay, so now we have those allocation rates. So now we will be able to reference that information when we're preparing our variances. So for our variable overhead cost variance, the formula is our actual variable overhead minus our standard cost times actual quantity. And so for actual variable overhead, they gave us 5,350 right here, minus a standard cost, which we calculated as 4 per direct labor, times the actual quantity. And so we had actual direct labor hours of 460. So over here, I'll calculate that in Excel. We'll again use the absolute value function. So 5,350 minus 4 times 460. And we have 3,510. And so just over here, I'm going to do it over here on the side. Let's calculate that. 4 times 460, and we get 1,840. And so when we're looking at this, we have an actual variable overhead of 5,350 but we were expecting it to be 1,840. So we know that this is unfavorable because the variable overhead was 3,510 more than the standard should have been. So then for the efficiency, variable overhead efficiency variance, the formula is the actual quantity minus the standard quantity times the standard cost. And so for the actual quantity, we have 460. And for the standard quantity, we know that it's 0.025 hours per fender. And we also know that there were 20,000 fenders produced. So that would be 0.025 times 20,000 times our standard cost, which we calculated up here as 4. Sorry, I accidentally scrolled our book. And so again, on the side, let's just quickly do 0.025 times 20,000, and we get 500. So if we're looking at this, we had actual quantity of 460, but a standard quantity of 500. And so we know that this is going to be favorable because we used less than what was the standard. And so we use our absolute, 460 minus 500 times 4, and we get 160 favorable. Then down here we can do our fixed overhead cost variance. Fixed overhead minus budgeted fixed overhead. And so when we come down, we can just pull this information. Actual fixed overhead, 26,000 minus budgeted fixed overhead of 23,000. And so we just know, I mean, we could do the formula, but we know that that is a $3,000 difference. And so now, is it favorable or unfavorable? Well, we actually spent $3,000 more than we had budgeted, so that would be unfavorable because we spent more money than we should have. And then finally, for the fixed overhead volume variance, we will use the formula budgeted fixed overhead minus allocated fixed overhead. And so we're going to need to calculate allocated fixed overhead. So I'm going to come down here, not fog, but fixed overhead. And if we scroll back up, we had calculated an allocation rate of 40 per direct labor hour. And we also know that we had direct labor hours. Where do we calculate that? Right here. I should have labeled this. That we have that allocation of 500 direct labor hours and remember this was our 0.025 times the 20,000 fenders because they told us up here the standard direct labor hour was 0.025 and we actually produced 20,000 fenders. So that's where the 500 comes from. So down here we're saying equals 40 times 500. And so for our fixed overhead volume variance, we have budgeted fixed overhead of 23,000 minus allocated fixed overhead of 20,000. And so we have 3,000 here. And this again will be unfavorable. And we know that it's unfavorable because the fixed overhead volume variance is not a cost variance, it's a volume variance. And so it explains why fixed overhead was under allocated. The variance is unfavorable because the company manufactured fewer fenders. They manufactured 20,000 fenders rather than the budgeted 23,000. Therefore, total fixed overhead cost allocated to production was $3,000 less than the total budgeted fixed overhead cost. So the 20,000 total fixed overhead cost was allocated compared to the 23,000 total budgeted fixed overhead cost that actually existed. So that's why it is considered unfavorable.